To your point, the first question is why self-storage? And what I found is that, unlike habitational real estate or houses or apartments, when somebody doesn't pay, you go through the process of, evicting them, which takes, a lengthy amount of time and right now almost impossible to do. In the meantime, they can stay in your place for free, destroy the place if they want to. And then when they move out, if they still have a job, I walk out of court with a little piece of paper and maybe the ability to collect. With self storage, if somebody doesn't pay, after 6 days, you lock them out. And then after 90 days, you sell their stuff and you recoup your money. And so that right there was the worth of the price of admission. And our turns in apartments and houses, and we're averaging about $1,300 a turn from lost rent and replacing or cleaning carpet and painting and repairs. Whereas in storage, well, once somebody moves out, we take a blower and in 30 seconds, we blow it out. It's a metal box on a concrete slab. We don't have all the repairs and the time it takes to put somebody else in.
Hi, everybody. This is Jose Luis Morales. Welcome back to the Morales Group podcast. This is episode number 46. Today, we've got a very special guest. His name is Scott Myers. He's a self-storage investor, self-storage educator. Today, he is going to be guiding us on how to get started on self-storage investing. He's going to be guiding us everything from A to Z. Welcome to the show, Scott. How are you?
I'm fantastic, Jose. How about yourself?
Good. Doing well. Excited for this interview, so I'm excited about it. So I wanted to start off just by asking, what makes self-storage different than investing different than some of the other asset classes? And then how did you land on self-storage? Meaning, did you automatically just say, hey, self-storage is the way that I want to go, or did you try other asset classes as well too before you got started?
I did. Yeah. How about I answer those in a reverse order? So I started investing in single family homes. I think like everybody who starts in real estate, typically bought a rental house back in the day when there was an assumable VA loan on it. I rehabbed it, refinanced it, rented it out using the BRRRR method, and rented it out on a lease option, assuming that the person was going to buy it from us at some point. So we take those proceeds and then we bought two more properties just like it. And we continued on until we found ourselves with about 75 single family homes. And I realized that, that was a lot of chasing the tenants around in the single family homes. So I thought, well, I'm going to scale this up by buying apartments. So I went out and we bought a number of apartment complexes, thinking, economies of scale would make it easier to manage and have a little more free time, but only to found that really just kind of compounded the issues. So we found ourselves with 420 apartments and 75 houses and just didn't have all, the freedom and the cash flow that we had expected. And so we were, still trying to slug it out until we get our mortgages paid down and get to that place where it was smoother sailing, but never really achieved that. So, barring getting out of real estate, I mean, we love real estate for all the reasons that afford us, the benefits of investing in, which is appreciation and depreciation at the same time. We can borrow money to buy it. And rental real estate is fantastic if it weren't for the tenants. So, as I looked around the landscape, the only thing left without tenants in real estate are parking lots, essentially, and self-storage. So I became a student of the industry, started looking into it. And to your point, the first question is why self-storage? And what I found is that, unlike habitational real estate or houses or apartments, when somebody doesn't pay, you go through the process of, evicting them, which takes, a lengthy amount of time and right now almost impossible to do. In the meantime, they can stay in your place for free, destroy the place if they want to. And then when they move out, if they still have a job, I walk out of court with a little piece of paper and maybe the ability to collect. With self-storage, if somebody doesn't pay, after 6 days, you lock them out. And then after 90 days, you sell their stuff and you recoup your money. And so that right there was the worth of the price of admission. And our turns in apartments and houses, and we're averaging about $1,300 a turn from lost rent and replacing or cleaning carpet and painting and repairs. Whereas in storage, well, once somebody moves out, we take a blower and in 30 seconds, we blow it out. It's a metal box on a concrete slab. We don't have all the repairs and the time it takes to put somebody else in. And so our, just a very shortened time frame that any unit is down and not generating revenue. So there's another, whole host of reasons why, but those two right there, I mean, if you were able to do that in your habitational real estate, lock somebody out and move them out and sell their stuff and recoup some of your money, and your turns, involve taking a blower and blowing it out, it'd be far more profitable. And so that's why I made the switch and the move over to self-storage.
That's awesome. Good for you, man. Okay. And then can you tell us about your first deal? I mean, what did your first deal look like in investing in self-storage?
Mm-hmm. Yeah, the first project that we found, we sent out some mailers and got a response from a partnership. There was two partners that were getting a divorce,
Uh-huh.
and they had really driven the performance of the facility down to the point that neither of them they disliked each other so much that neither of them wanted the other one to make money. It was kind of the craziest thing, but
I
so they
see.
devalued the property.
Uh-huh.
And we found it and way undervalued, and purchased the facility below market value, way below appraised value. I borrowed money to for the down payment from a self-directed IRA because it was a partnership that I was entering into, and then I had a partner who also put money into it. So we split the guarantors on the loan. We each had money that we put into the project and purchased it, leased it up. Put a kiosk in place of many of the manager's hours to reduce the manager's hours, filled the facility up, and then we bought the land next door and added another 250 units on top of that to the facility. And then I sold out to my partner several years later.
Good for you, man. Congratulations. Okay. And
Thanks.
just out of curiosity, did you end up keeping the rest of your residential units, like the apartment complexes and all the single family houses?
Mm,
Or what ended
no,
up happening to
We're,
that?
we're we're down to one house, and it's the one that I live in right now.
That's
That's it. That's it. So we sold off the rental houses in bunches, and then sold the apartment complexes off individually. We didn't not immediately. We began to follow our the process of creating the value in the apartments as well as the houses, and we did sell them at the top, per our original plan. But once we bought our first self storage facility, we immediately halted acquiring any other single family homes or apartments.
good for you, man. And then, so let's say that I'm a new investor in basically self storage.
Mhm.
How would I go about finding opportunities for this, and how would I go about, how would I go about finding the opportunities? I know that you said that you went direct to owner on that. Is
Correct.
that really
Mhm.
like the best method? Are there brokers that specialize in
Mhm.
this?
Yeah.
Yeah.
So all of the above. Certainly there's commercial brokers that are self storage specific brokers, depending upon the market that you're located in. Certainly in your market, we find that as well from the big folks like Argus and Sperry Van Ness and Marcus and Millichap, Remax Commercial as well. That specialize in self storage, so we create that relationship with them, and doing the same things that I would do, with you, Jose, which is call you up and tell you what I'm looking for, and say, hey, when you run across something, we're players. We're not tire kickers. If you run across something, give us a look. And, in 48 hours, we'll give you an offer so that you don't have to try to pull together all, put together the offering memorandum and pull together all the books and everything else from the sellers. And if we strike up a deal, then, we'll give you full commission. We don't take anything on this side. So it's always creating relationships with the brokers like yourself. Then on the individual side, we're out doing the same things that you do, which is sending mailers out to the individual owners and saying, hey, when you're ready to sell, give us a call. And try us first before you shop it with a broker. So we're working both sides, and those are the two main ways that we find opportunities. Outside of that, then it's virtual assistants that are combing the internet for the multiple sites out there for small businesses, because many owners, they view their facility as a small business. There are other, do-it-yourself listing sites that people put their facilities on, and just combing the landscape as well as, driving the market and pulling on doors and going in and talking to the folks behind the counter. Usually there are managers, sometimes they're the owner. So there's really 11 different ways that we use to find facilities and market for facilities. But those are the three main ones that have produced the most results for us.
So essentially 11 different ways. Okay, good. So
Mhm.
let's pretend that I am a broker, and let's say that
Yeah.
you call me with what you're looking for. What would a call like that look like?
So I would come to you and say, listen, here's what I'm after, Jose. I am a value add buyer.
Huh?
And that means that, for all those things that your buyer's list is looking for, I'm the one who will buy the other stuff. So, Jose, I know that you're interested in getting paid, and the way that you get paid is by having a nice, clean deal that'll go to closing very quickly, that is bankable, and where a buyer can, get financing for it. Well, I want all that other stuff. You and I are both sending postcards out into the marketplace. I'm sending them out to buy their facility as an owner. and you're sending them out. And I've seen your postcards, Jose. They're fantastic. And when they land on the desk of the seller, and sometimes they look at it and they say, well, I think I'm going to go with an individual. So what I would ask is when you get those small mom and pop owners that get your mailer, because as your mailer says, you're the king of self-storage, and you're going to get them more money than anybody else in your market. They're going to call you. But unfortunately for you, as you know, many times it's that mom and pop seller that they got a 100 unit facility where, the records are in unit number 102 or it's a 100 unit facility, unit number 78, and somewhere in the back of their pickup truck. And it's going to take you weeks or a month to pull together an offering memorandum. And then by the time you get it out to market, you're going to have a bunch of tire kickers that don't really know what they're looking for, a bank that's not going to be able to finance it because they can't make heads or tails of the numbers. And, by the time it's all said and done, if you happen to get to the closing table, as you and I both know, once you split the commission and then split it with the house, there's not much left. Well, you'll want to take my number down. So when you run across those, give me a call. Give me the information that you have, whatever you have. I'll go take a look at it. We've got our own financial models. I know what the underwriting looks like on these things. I can come up with my own valuation and I can fund it. If we're interested, we'll give you an offer. Again, we're not tire kickers. We're not trying to steal anything. We'll give you a fair offer. You'll get full commission. And hopefully, if you haven't had to do a whole lot of work, what we'd ask is that, perhaps you take 1% off or so. Instead of a full commission at 6 or 7%, that you take 1% off if we come to you and strike up a deal on this project. And we'll close quickly. We've got private equity partners. We have cash. We have lending relationships and the ability to close these projects pretty quickly. So is that something that is of interest to you, Jose?
Yeah, absolutely. That would be of interest to me. So basically, you're reaching out to them, giving them the benefits of working with somebody like you, and basically just letting them know that you can make this a very easy transaction for them, and to keep in mind as what would be a pocket buyer. You said that there was some websites that people can find, like a buy owner type of self-storage. Can you give one of those websites?
Yeah. So selfstorages.com is one of them. List Self-Storage is mostly brokers that started out as individuals. Listselfstorage.com, but there's also now a whole lot of institutions and brokers coming on there. Not that that's a bad thing, but when people are looking to not pay commissions or to deal with the owner, they can't always find them. So those are two of the bigger ones out there right now, and there's a few others that pop up from time to time as well.
Okay. And then let's talk about markets. How do you find what markets you want to kind of be in as it relates to self-storage? Are all markets rated equal basically on this? Or are there markets that are better than others?
Yeah, there's a couple of ways of answering that, Jose. And everybody's always looking for, what's the best market, Scott? Where should I be looking right now? And the answer is always your backyard first. Begin looking in your backyard, because I see there's multiple ways of answering that, because a market is, we consider, what does that look like? Ventura is a market, obviously. So is Sheboygan, Wisconsin, but so is a 2 or 3 mile radius of this facility that you're looking at. Somebody answered your mailer, and now you're going to do a market analysis within 3 miles. So how do you know if it's a good market or not? Well, there's a supply index. It's a measurement of the amount of self-storage per square foot per person or per capita in that market. And so equilibrium in our industry is somewhere around 6.5 to 7.5 square feet per person, depending upon which consultant and which magazine you read. But that is usually where supply equals demand. If it's a market in which there's only 3 square foot per person, well, it's an undersupplied market for self-storage. If it's at 10, it's an oversupplied market. So that's how we determine a market to invest in. We kind of back into it after we find a deal. So if you're looking now specifically for a market that you're going to focus on, then any growing market that we want to go into, just like probably any other form of real estate, we want to be in the path of progress. So we get to be first to get best choice of land, be in the path, where everything is coming up, get the land a little bit cheaper than once it becomes an infill location. And then looking at the current competitors, even if they are several miles away, are they holding a pretty good rental rate per square foot that will support building a new facility or buying an existing one? So again, a number of factors that we could easily take an hour just talking about market analysis, but we back into it after we find a deal, and then any other market out there that you're looking at that has growth is one. But don't overlook your backyard. The grass isn't always greener.
No, that's kind of what I tell people myself too. About a lot of people want to invest in apartments. Mm-hmm. Able to find some good deals in my area, and basically just by knowing that there are good deals, that they're rare, but I want to be the guy that when a good deal comes up, I want to be the guy. So I tell people I can find five to 10 good deals in my market in a year. I want to buy 3 or 4 of those good deals.
Yep, that's fair. And
if I can do that, then I'm pretty happy with
good model. Yep.
Yeah. You said that equilibrium is at 6. So how would you just look up the population for that hometown and then basically look up how much self-storage there is, or how would you go about doing that? Is that like LoopNet, CoStar, or are there certain platforms that you would find this information?
Yeah, all the above. So, we can back into that once we find a site that we're interested in. Of course, it's not real easy to draw, a circle around that, but we can. We've got tools. We pay for Yardi Matrix, which is a very expensive software tool that we can model out and find out who the competition is and compare that against the population. If you're doing it on your own, then you draw a circle around it. You can get census data, go to citydata.com or some of the other, you probably know better than I do, something places. I forget what the other one is. Google. And then you Google map the rest of the facilities in that area within a 3-mile radius. And there's a drawing tool if you go to Google Maps Pro. And you can then draw over the roof lines, and it'll automatically equate the square footage of the self-storage facilities in a market. So you can get pretty darn close to dialing it in, either if you want to do it yourself or hiring a virtual assistant to back into those numbers and get close. You can hire consultants that can do a desktop study for you. And for a few $100s, if you're really serious about a site, in the beginning, they will do that for you. And then further down the road, if you're looking to develop, then you can pay a few $1,000s, and they'll complete a full feasibility study to determine whether a site is worthy of building or buying in.
What would I look for? Is there a specific type? Obviously, it would vary in types of zoning, but is there a specific type of zoning that we should look for if someone's looking to develop? Because I saw a couple self-storage facilities come up in my market, and I tried looking up the zoning, but I couldn't really find anything that was like an immediate trigger. Because sometimes maybe somebody has a piece of land that that could be developed into self-storage, and maybe I don't know it as a real estate agent, but if I did, I mean, it would probably allow a little bit more. So, is there something to look for if somebody is trying to develop a piece of land into self-storage?
That's good, Jose, that you recognize when you see a piece of ground that would be good for self-storage. And the next thing to do is to look and to see what it's zoned for, and then drill down to see if self-storage is an approved use of that land. And it's different all across the country. Every municipality is different. So self-storage may fall under C3, which is almost general commercial. Sometimes it's C1, sometimes it's U3. At the end of the day, you need to find out in the areas that you're constantly looking into, find out what designation self-storage fits under, and then see if it is already approved for that. Now, if it isn't, it doesn't mean that you just move along. It means that you then contact the zoning office or stop in there and make an appointment and ask someone to say, listen, here's this 5 acres over here. It's a zone C3, but I see that self-storage is not an approved use. What kind of, is that going to be a long road to hoe? What is the city's appetite for approving self-storage at this site if I were to go down this path? And do I have to get it rezoned? Is it an approved use, or is it just a permitted use where it's a real simple project or in a simple process to make that happen? So you just got to go ask the questions. But you'll be able to find it online if you already know what the zoning is, whether self-storage is underneath that. But again, I think many people stop if they see it as an already zoned that way instead of digging in further to find out what it's going to take to get the proper zoning.
Yeah. Is there a rule of thumb for like construction cost for like self-storage, like to be able to underwrite the deal? And we're going to transition into the underwriting aspect now. But like, let's say I find a piece of land, talk to the city says, yes, you can develop. is there a rule of thumb as to how much per square foot that it would approximately cost?
Yeah, so I don't know rules of thumb, but just kind of average rates that we're looking at right now, and depending on again who you talk to, I think a safer number is somewhere around $40 to $45 a square foot if we're talking all metal single story buildings. So again, this is not inclusive of the land. This is just for the buildings themselves. And $45, closer to that, or maybe a little higher, includes the concrete pad. But again, that just depends on how much concrete costs in your market and how you're planning to build. When you're going two-story, climate controlled, more like the Class A facilities that people would see that are built by the big guys and gals, then you're looking at usually 55 is the lowest, upwards to 80 and even $90 a square foot, depending upon the market and what type of a architectural review board you have, and if they're really aggressive on how they want you to build it and what they want it to look like.
Okay, cool. So let's say that I do find an opportunity. I know that we briefly talked about like the equilibrium of the marketplace. I know that we also look for value add opportunities. How would I go about like just some basics on how to underwrite a deal? Like, let's say I find a mom and pop shop. It's basically under or the rents are below market, or basically not filled to its full potential. How would I go about underwriting a deal like this?
Yeah.
What type of financing is available to somebody with let's say no experience in self-storage?
So the underwriting piece, assuming you have no numbers, you can't get a hold of anything right out of the gate. Well, first of all, the good news is there's a lot of data that's available already. So you can look at the rental rates in the market. So look at a 3 to 5 mile radius. You can go online, and there's a number of aggregator sites as well as just the individual sites themselves, and see how much they're charging for a 10 by 10 and a 10 by 15 and a 10 by 20, and do that for the competitors in the market. And then you come up with an average rental rate per square foot. Now, as we underwrite commercial properties, as you know, Jose, we look at everything that is on an annual basis. We look at everything on an annual basis. So we get our annual rental rate. Then, if we're looking at the size of this facility, we can go to Google Earth Pro. We can look at the amount of square footage that the facility is, and then just assume from the other projects that have traded, in the market by going to CoStar and getting comps. What can we expect to pay per square foot in this market, or at least get an idea of the appraisal amount. So thereby, we may have a basis for buying it, or go into the tax records and find out what the last price was that it was paid for, or a value that was assessed at recently. And then you've got the numbers. So it's 200 units. You can look at the average rental rate per square foot. You've got your income. Expenses, most of those you can generate by looking at the taxes online. Insurance, you can get a bid for that. And if you don't want to go through all of those and you're not familiar with self-storage, then throw in an average of 35% of your income, and that is your expense ratio. So in self-storage, it averages anywhere from usually 28 to 35% for a single story facility like that. So you've got your revenue because you got it from the market. You know the size, you know what that looks like when it's stabilized at 85% occupancy. 35% expense ratio on top of that, subtract it, is your net operating income. And then simply apply a market capitalization rate, which again, you probably receive from CoStar and some of these other facilities that sold, and it'll get you in the ballpark. It's a range of what you think that is worth and what you'd be willing to pay for it. And then once you get a hold of the seller, then you know whether you're in line or not.
Perfect. So essentially, 100,000 gross revenue. You take a 35% expense ratio, approximately, just to kind of do some quick numbers, and 15% vacancy expense. So you multiply. So if it's 100,000, you could basically expect to receive about $50,000 of 50% with the vacancy and the expense, and then that would give you the NOI approximately.
Potentially, except that our gross rent is based upon an 85% occupancy. So we start there because we assume, and bankers and appraisers, they'll never take it up to 100. So we don't either. So we start there at 85%. That is our gross that we're going to use. And then we subtract the 35% expense ratio. Perfect.
Okay. That clarifies it for me. Okay, perfect. So let's say that we underwrite it, and let's say that the deal does make sense. Let's say that we get it at a reasonable cap. How do we think about financing? Like, what do the banks typically look for? Do they look for 20%, 30%, 10%? What would financing look like?
Well, first of all, we're very fortunate in our industry that we are the only real estate industry that the SBA offers loans on. And that is because they treat it as a business. They treat self-storage as a business. And so we have the SBA 7A and the 504 loans available to us, and they will go up to 85% LTV and do it at 4.5% or 4% interest rate. We've even seen some that are sub 4 right now. And so 85% loan to value at sub 4% interest rate is fantastic. And it's backed by the SBA, which it is a full recourse loan, but they are in the business of getting money out into the marketplace. And so they definitely, and they love self-storage because it has the lowest loan default rate. So it is not very difficult to get a loan for self-storage.
Wow.
That is always the first place that we go to is the SBA. But then for the same reason, the community banks, the savings and loans, the credit unions, they're in the business of making loans to preserve principal. They want to get that back and make money on it. That's secondary. And because self-storage has the lowest loan default rate, there are also many of those banks, community banks, credit unions, savings and loans, that are clamoring for self-storage facilities. They want these things on their balance sheet because they know it's rock solid. It works very well during good times in the economy when people buy more stuff and they store more stuff. But it works even better in a recession when people are downsizing and businesses are downsizing. We have a run up in occupancy at that point and a run up in rates and in demand in general. So it is that recession resistant and inflation resistant asset class in real estate that the lenders love.
Yeah, that's awesome.
So the second piece of that, if I could, is you mentioned, what kind of LTVs. When you're with the credit unions and savings and loans and community banks, it's always going to depend upon the project itself and your credit. But that's when you get back down into that 20 to 25% down instead of a 15% down that you would have with the SBA.
Okay, so SBA 15%, and then traditional could be 20 to 30%, essentially. SBA. Awesome. Okay, cool. Yep. What about like the due diligence process? Like once we get into, like, let's say that we secure the loan, what type of due diligence should someone do in self-storage? Like, do you walk every unit? I know that you talked about some of the mom and pop shop people don't have accurate paperwork as well. What do you request in the due diligence period, and what do you look for?
I look for everything. I mean, you make money in any investment when you buy it, and we want to uncover everything. So my due diligence checklist of the items that we ask for from the seller, from the broker, is extensive. So, anything and everything. And again, there's another area we could talk about an hour about the things that we look for. So I want historical financials. I want their tax returns, their Schedule E for the property, rent rolls, if they have property management software. I want anything and everything out of that to look at the financial performance. We're going to walk the entire facility. And to your point, to be able to go into all units, there's good and bad when it comes to self-storage. The good news is we don't create bailment because meaning liability, because we never take a key to a unit. It is self-storage. So we don't take on any liability. If you could call it that, the downside is when we go look at a facility, we can't get into each and every unit. Is it a big deal? Well, it's a metal box on a concrete slab with stuff in it. We're not going to be surprised by anything like, in our apartment days when we used to buy those, we could only get access to 10, 15, maybe 20% of the units before we buy it, for obvious reasons. We don't want to go in there and they don't want to disrupt everybody. So of course they show us the best ones. And then, the ones that had meth labs and that were destroyed and had mold and everything else. Those are the ones we found after they turned or after we bought it. So there's really no surprises. But from that standpoint, we hire inspectors to inspect the HVAC units in the office, and if it's a temperature controlled facility, to check the roof, to check the drainage on the site, the doors, lighting, everything else on it. So yes, we uncover everything. It's a predictable business model, but it doesn't mean it's a simple, easy business and that you shouldn't do your due diligence, because that's how you preserve your investment, and how you make money is on the front end. And you definitely want to make sure you don't avoid any mistakes by learning that due diligence process backwards and forward.
What would be something that maybe a newbie investor wouldn't, as opposed to a seasoned investor would catch in the due diligence process?
Unfortunately, I've seen, Jose, several newbie investors that they just don't even do any due diligence. It's like, oh, this, the broker's listed, they're with a reputable company. Why would I question anything that this broker puts out? And they go to closing without doing that. That is the first and biggest mistake. Second is, really just digging into the numbers. If you don't understand the art and the science behind underwriting, and if you can't flesh out whether these numbers are real or not, or spy phantom leases, or giving credit for late rent that is late and that goes to auction and rental loss. I mean, there's a number of ways that people can, not intentionally, although some people do, trick the numbers when they're getting ready to sell it, but just doing a solid underwriting process on it. I think people are just doing a disservice not understanding and learning that process, and just waiting on the appraiser to give a number, or from what they've seen on the surface it looks good and the broker makes it sound like a great deal. It's not until you get into the underwriting and dig into each and every line item of the expense and understand whether that's high or low compared to other properties and other projects. You need to question each and every one of those, and I think that's where people make mistakes. And sometimes it's just unknowingly, because they don't have the experience behind them and the understanding and the wisdom of knowing whether these numbers truly are realistic when they buy it.
Perfect. Now, let's say that I'm looking at a storage facility, and let's say that, obviously, like you, I'm looking for a value add. Some people may not know what a value add opportunity is. When I'm residential, I didn't really know what a value add opportunity is until I got into commercial space. So what is a value add opportunity, and what are some of the value add opportunities that you look for in self-storage? How can you add value to a self-storage facility?
Well, the good news is, with an income producing property, is that it's valued based upon the net operating income it's producing today, and applying a market cap rate. So if it's only 50% occupied, you're going to take the NOI at 50% and you're going to divide that by a market cap rate, and this is the value of it. And by the way, that's all the bank's going to lend on because of the debt service coverage ratio. So if it's 50% occupied and you're buying it at a 7 cap based upon that net operating income today, because that's what'll get funded. Well, when you close on it, that's the market cap rate on that NOI. In essence, you got 50% of the rest of the building for free, and now you just lease it up, and the new NOI at a market cap rate creates the value of that facility at that point. That is completely different than a house where there's 5 others, 10 others, that are just like it in the neighborhood, and here's the highest, and this one's about the same as that. Well, there's no ceiling on these projects. You just continue to create value by adding profit centers, like selling locks, boxes, and moving supplies, and tenant insurance, and adding concierge services to boat and RV parking. I mean, there's a number of ways to be able to do that, but the primary ones are buying these facilities that aren't managed well. They are high vacancies. The rent is way below the market, and if they have land that you can still build on, then we want to add more units anytime we can. Or if there's land that is next door that we can buy and then add additional units on and get that economies of scale from a management standpoint, those are some of the simplest and easiest ways.
Yeah. What about marketing? Like, I know that we talked about, like, you take a building that's like 50% occupied. How would somebody go about filling that? Because essentially, I mean, how would you go about filling the rest of the units?
Become a master marketer in the business. Aggregators are one of the ways that we do this, by the price lines of self-storage. So Sparefoot is one of them. US Storage Search, making sure that you're visible on those so that you can compete with the big guys. The other and the primary one is set up a website so that people can find you, and make sure that you're doing everything in your power from an SEO standpoint, or even paid marketing, to get up high, because it's a commodity. Self-storage is a commodity. People aren't looking for school systems or that it's really close by work. They do want it to be close to home, but they're not looking for anything other than that. It's close by home. It's safe. It's secure. It's clean. And you know what? If I can get on my mobile phone and I can rent a unit or I can reserve a unit, then they win. They aren't going to go shopping around. This is an item to check off their to-do list for the day.
Perfect. So basically, if you can rank high on the SEO, that would help you. The last thing I want to ask you is just what lessons have you learned, or like what has been one of the most expensive lessons that you've learned that maybe, like, if you didn't have a mentor what's been one of the most expensive lessons that you've learned while investing in self-storage?
Gosh, in self-storage, I haven't had many expensive lessons, thankfully. I mean, the first one that comes to mind is back in my apartment days. The first apartment complex I bought, I just, I got the appraisal and I was like, woohoo, it matches the purchase agreement. And the lender said yes, and we went to closing. And I didn't bother to read the appraisal. And I didn't bother to really, get adept at underwriting like I needed to realize, oh, I probably overpaid for this thing. And the lender's just looking at these numbers as well for it to cover. And I didn't make the profit that I wanted to. So that's probably one of the most expensive. So learn how to underwrite and don't take an appraisal at face value. As far as in storage, there's just not too many surprises. I mean, the due diligence, we find anything in there, but the only gotchas were really on a partnership. I had a partnership that didn't go so well. And that's one that, no mentor or anybody else is going to really be able to help. If somebody turns into a scoundrel, they turn into a scoundrel, and there's nothing you can do about it, I think. But I guess for many of our students, what I've seen, the mistakes that they make is one that I've already mentioned, and that is, and then also folks that just don't bother to get a mentor or coaching, and that is, they just don't learn how to underwrite these things, and they don't know what they don't know. And so they look at the numbers, they take things at face value, only afterwards to realize that, oh my gosh, there's a couple of line item expense items that I didn't even account for, and I didn't know what to look for, and they didn't include it. And now I'm faced with these, and I didn't put high enough management expense in here as a percentage of the income. I just didn't know how to account for that, only to find out that third-party management companies are 2 times more expensive than I had anticipated. So it just anything on the front end, just learn the business and make sure that you're underwriting these properly, and then get another set of eyes and have a consultant and appraisal, check your underwriting before you pull the trigger on something.
What does your coaching program look like? Like, for example, like for students, like if somebody wanted to get involved in your coaching program.
So we have a number of resources. We have home study systems and software, and a lot of do it yourself, if you will, ways to be able to fill in the gaps and learn about the business. There's people that want to work with us. They want to do it for the reasons I just mentioned, which is accountability, first of all, to make sure that they do it, have somebody to keep after them to get out there and do the things they need to be doing. But then they don't know what they don't know. They want somebody to say, hey, what am I missing here? What have I not thought of yet? What are some of the considerations that I'm missing here? Where are my blind spots? And we point those out as well. But then in the higher levels, it's, they get access to our Rolodex of vendors and lenders and private equity partners, and then time with us, depending on the project. If they're interested in partnering, there's an opportunity to partner with us on projects where we build the team around the project, and our team becomes their team, and they move on down the path with somebody on their first one that they would probably profit more, even in a partnership with us, than they would by doing something on their own.
Yeah. All right, Scott. Well, I wanted to say thank you for being on the show. I appreciate. Obviously, I know that you're a wealth of information. I across you, we have a mutual friend, Alex Casada. I believe that you was on the podcast as well.
Yeah.
And so I'm very curious after hearing a couple of things about investing. I own an apartment. Some of the things in apartments seem a little bit not easier, but a little bit less management intensive. If people get a hold of you, where could they find you?
Yeah, easiest ways. We got a couple of websites out there. One is selfstorageinvesting.com. That is our main platform where we teach people all things about self-storage. And then on the passive side of the business, we do syndicate, and we put together private equity partnerships with people on our projects. And that is at passivestorageinvesting.com. And you can learn, you can see what we're doing on that end as well. Once we teach people how to go out and do this business, but then also to invest passively, that is where you would go as well.
Awesome. Thank you so much. This is episode number 46 at the Morales Group Show. I've enjoyed it. Thank you for sharing. Let's stay in touch. I will likely be giving you a call in the future to set something up. I'm pretty confident I'll run into, or I'll end up buying a storage facility in probably the next 2 to 3 years. So,
be happy to help. Say hello to Alex if you see him before I do as well. And it's been a pleasure, Jose.
Thank you so much, Scott. I appreciate your time.
All right. Take care.